If you're planning to pass your home to your kids one day, stop what you're doing and watch this entire video, because what I'm about to share could save your family hundreds of thousands of dollars. Most parents think leaving their home to their children is one of the greatest gifts they can give, and it absolutely can be. But there is a massive, life-altering tax trap hiding inside that gift that most families don't discover until it's too late. We're talking about a tax bill so large it can force your kids to sell the very home you worked your entire life to pay off. This is the trap nobody at the dinner table is talking about. But the IRS absolutely knows about it, and today we're going to expose it completely. The common mistake most families make. Here's what most American parents believe. I'll just leave the house to my kids in my will or add them to the deed and everything will be fine. It sounds simple. It sounds safe. And honestly, it sounds like the responsible thing to do. But here's the brutal truth. The method you use to transfer your home to your children makes an enormous difference in how much of that home they actually get to keep. Most families assume the government stays out of it. Most families assume that because they already paid for the house, there's nothing left to owe. And most families are dead wrong. The IRS has a very specific set of rules about how inherited and gifted property is taxed. And if you don't know these rules, you could accidentally hand your kids a financial nightmare instead of a financial gift. The single most common mistake families make is transferring the home the wrong way, and they don't find out until it's too late to fix it. The massive tax trap. Nobody talks about. Let's talk about the real trap. It's called capital gains tax, and it's triggered by something called your cost basis. Here's how it works. When you bought your home, let's say you paid $150,000 for it back in 1995. That $150,000 is your cost basis. It's what the IRS considers you paid for the property. Now, fast forward to today. That same home is worth $600,000. That's a gain of $450,000. While you're alive and living in that home, you don't owe a dime on that gain. But the moment you transfer it, either as a gift during your lifetime or the wrong way at death, that gain can become fully taxable to your children. Now, here's where most families get it completely wrong. They think, well, I'll just put my kids on the deed now, or gift them the house and avoid probate. What they don't realize is that when you gift someone a home, they inherit your original cost basis. So if your basis is $150,000 and the house is now worth $600,000, your kids could owe capital gains tax on $450,000 of profit the moment they sell. At the federal long-term capital gains rate of up to 20%, plus state taxes in many states, that could be a tax bill of $90,000, $100,000, or more. Gone. Vanished. Money your kids will never see. But here's the part that almost nobody talks about, and this is the key to everything. If you do this the right way, through a proper inheritance at death, your children receive what's called a stepped-up cost basis. That means the IRS resets your home's cost basis to whatever it's worth on the date you pass away. So if the house is worth $600,000 when you die and your kids inherit it and sell it for $600,000, they owe zero capital gains tax. Absolutely nothing. That one rule, the step-up in basis, is one of the most powerful wealth transfer tools in the entire tax code. And tragically, millions of American families accidentally throw it away every single year by trying to be proactive and transfer the home too early or in the wrong way. How this trap actually works with real numbers. Let me make this crystal clear with a real-world example because this is where families truly feel the pain. Meet Bob and Carol. They bought their home in Phoenix, Arizona in 1990 for $120,000. Today, that home is worth $580,000. They have 2 adult children, Michael and Sarah. Bob and Carol want to make sure the kids get the house without any hassle, so they decide to add Michael and Sarah directly to the deed right now, thinking they're doing the smart thing. Here's what just happened without Bob and Carol realizing it. They just gifted half the home to Michael and Sarah. And the IRS says Michael and Sarah now have a cost basis in their half equal to Bob and Carol's original basis, which is $60,000 for their half of that original $120,000 purchase price. When Bob and Carol eventually pass away and the kids sell the house for $600,000, Michael and Sarah owe capital gains on the difference between their $60,000 inherited basis and the $300,000 they received from the sale of their half. That's a taxable gain of $240,000 per child. At the federal rate of 15% to 20%, we're talking anywhere from $36,000 to $48,000 in federal taxes alone per child. And if they live in a state with its own capital gains tax, like California or New York, add thousands more on top of that. Now, let's look at what would have happened if Bob and Carol had done nothing, just left the house in their names and let it pass through their estate properly. Michael and Sarah would have received the home with a stepped-up basis of $600,000. They sell it for $600,000. Their capital gains tax? Zero. The difference between doing it wrong and doing it right in this example is over $80,000 in taxes that Michael and Sarah will never get back. And this isn't a rare edge case. This is happening to families across America right now. The IRS collected billions in capital gains taxes last year that never needed to be paid if families had just gotten proper advice beforehand. Other dangerous ways people pass homes and why they fail. Now let's talk about the other popular methods families try, because most of them come with serious risks that people don't see coming. The first one is joint tenancy with right of survivorship. A lot of parents add a child to the deed as a joint tenant, thinking it avoids probate and smoothly transfers the home. And yes, it does avoid probate. But here's the problem. You've just made your child a co-owner right now. That means if your child goes through a divorce, their spouse could have a claim on part of your home. If your child gets sued and loses a lawsuit, creditors can come after their share of your property. And as we just talked about, you've potentially wiped out the step-up in basis on their portion. One bad life event for your child, a divorce, a bankruptcy, a lawsuit, and your home could be pulled into that mess while you're still alive and living in it. The second dangerous method is outright gifting. Some parents think they can just transfer the deed to the kids as a gift and call it a day. Beyond the capital gains issue we already covered, gifts of property over $18,000 per year trigger the requirement to file a gift tax return. And while most people won't owe gift tax outright due to the lifetime exemption, it still chips away at your estate tax exemption, which matters more than ever given that the current elevated exemption thresholds are set to decrease after 2025 unless Congress acts. The third method people try is doing nothing at all and just relying on a will. A will does work, and it does preserve the step-up in basis. But the problem is that a will goes through probate, a public court-supervised process that can take months or even years, cost thousands in legal fees, and create family conflict. In some states like California, probate on a $600,000 estate can cost $15,000 to $25,000 in attorney and court fees alone. There has to be a better way, and there is. Smart strategies the wealthy use to avoid this trap. Here's what the wealthy do, and here's what you should be considering too. The first and most powerful strategy is the revocable living trust. A revocable living trust lets you keep complete control of your home while you're alive. You can sell it, refinance it, live in it. Nothing changes for you. But when you pass away, the home transfers directly to your children outside of probate, with a full step-up in basis, privately and efficiently. No court, no months of waiting, no massive legal fees eating into what your kids receive. And the best part, it's not just for millionaires. Setting up a basic revocable living trust typically costs between $1,500 and $3,000 with a qualified estate planning attorney. That's a one-time cost that could save your children tens of thousands of dollars in taxes and probate fees. The second strategy worth knowing about is the Qualified Personal Residence Trust, or QPRT. This is an irrevocable trust specifically designed for high-value homes. You transfer your home into the QPRT, continue living in it for a set number of years, and at the end of that term, ownership passes to your children at a significantly reduced gift tax value. This is particularly powerful if your home is likely to keep appreciating in value. It's a more advanced strategy, but for the right family, it can save enormous amounts of money. The third strategy is using the current federal estate tax exemption intelligently. As of now, each individual has a federal estate tax exemption of over $13 million, meaning most families won't owe federal estate tax at all if they plan properly. But, and this is critical, that exemption is scheduled to drop significantly after 2025 unless Congress extends it. Wealthy families are acting now to lock in planning strategies before that window closes. You should be thinking about this too. And finally, for families with income-producing properties or multiple real estate assets, a family limited partnership, or LLC, can be an effective tool for transferring real estate value while maintaining some control and taking advantage of valuation discounts. These are sophisticated strategies that require an attorney, but the tax savings can be dramatic. What you should do right now. So here's your action plan. Clear, simple, and something you can start on this week. Step 1. Do not add your children to your home's deed right now. I know it feels like the safe and loving thing to do, but as we've covered today, it can cost your kids dearly in taxes and expose your property to their personal legal risks. Step 2. Pull out your home's original purchase documents and find your cost basis. You need to know the difference between what you paid and what your home is worth today, because that gap is exactly what's at stake. Step 3. Schedule a meeting with an estate planning attorney. Not a financial advisor, not a general practice lawyer, but a licensed estate planning attorney who specifically handles trusts and property transfers. Many offer free or low-cost initial consultations. Step 4. Ask that attorney specifically about a revocable living trust and whether a QPRT makes sense for your situation, given your home's value and your age. Step 5. If your state has its own inheritance or estate tax, states like Oregon, Massachusetts, and Maryland have estate taxes with much lower thresholds than the federal limit. Make sure your attorney accounts for that in your plan. And step 6. Have an honest conversation with your children. Show them this video. Make sure they understand what's at stake so they can advocate for themselves and for your family legacy. The cost of planning is a few $1,000s. The cost of not planning can be 6 figures. That math is not hard. Here's my final warning, and I want you to hear this clearly. The tax trap we talked about today is not theoretical. It is not rare. It is happening to families right now. Families that loved each other, planned ahead in their own way, and still handed their children a massive, unexpected tax bill. The IRS is not going to call you and warn you. Your bank is not going to flag it. And by the time most families realize the mistake, it's already done, and it cannot be undone. Your home is probably the largest asset you own. It represents decades of your life, your work, your sacrifice, your love for your family. Do not let a paperwork mistake or a misunderstood assumption erase a significant portion of that legacy before it ever reaches your children's hands. You have the power right now to fix this. The window is open, but it won't stay open forever, especially with tax laws changing and exemptions set to shift after 2025. If this video helped you see something you hadn't considered before, please share it with someone you care about. Hit that like button so more families can find this information before it's too late for them. And if you want to go deeper on estate planning, retirement tax strategies, and protecting your family's wealth, subscribe to this channel right now. Because we cover these topics every single week in plain English, with no jargon and no sugarcoating. Your family worked too hard for you to leave their inheritance to chance. Go make that call to an estate planning attorney this week. Your kids will thank you for it.